Silver warning. 25 Ma's new silver short crushed. This is not a headline, it's a signal. Because when 25 million ounces of new paper pressure enters a market already under strain, it doesn't fail loudly at first, it tightens. Quietly. What happens when promises multiply faster than metal can move? When confidence holds the system together and confidence is the first thing to thin out. This isn't about price charts, it's about structure. It's about pressure. It's about what breaks after everyone assumes stability. And the most dangerous moment is not when panic starts. It's when calm still looks convincing. Stay with this, because by the end, the real question won't be what happened to silver. It will be who saw it coming. Welcome to Boring Currency Reports. If they value calm thinking over noise, experience over excitement, and warnings delivered before headlines, then they should consider subscribing, not as a click, but as a habit, like reading the morning paper used to be. And before it begins, they should say in the comments where in the world they are watching from, and what time it is there. They did not call it a crisis. They did not ring an alarm. On the surface, it looked like just another aggressive move in a familiar market. But beneath that calm surface, something unusual had happened. In a very short period of time, more than 25 million ounces of new paper silver shorts appeared in the market. For experienced observers, this was not just a large number, it was a signal that pressure was building in a system already carrying weight from many directions. Silver is not a normal commodity, it lives in two worlds at once. On one side, it behaves like money. It is held as protection against currency risk, inflation, and loss of trust in financial systems. On the other side, it behaves like an industrial input. It is consumed by factories, electronics, energy systems, and medical production. This dual role makes silver unusually sensitive to stress. When either side tightens, the entire system feels it. In paper markets, short positions are common. Many are legitimate. Some are used to hedge production. Some are part of complex trading strategies. But size and timing matter. When a short position grows too large too quickly, it stops being neutral. It becomes directional pressure. This is where the 25 million ounce figure matters. That amount represents more than casual positioning. It represents confidence. Confidence that price can be controlled. Confidence that liquidity will remain available. Confidence that delivery will not be demanded in meaningful size. These assumptions usually hold, until they don't. The futures market is built on rolling behavior. Most participants do not want physical metal. They want exposure. As long as positions are rolled forward, the system works smoothly. But this stability depends on trust. Trust that contracts can always be closed. Trust that inventory exists if needed. Trust that volatility will stay within familiar limits. Large, short positions lean heavily on that trust. When prices begin to rise instead of fall, shorts face a problem. Losses increase as price moves against them. Margin requirements can rise. Liquidity thins as fewer sellers appear at higher prices. What looked manageable during calm conditions becomes fragile during acceleration. This is why speed matters. A slow build of short exposure gives the market time to absorb risk. A rapid build compresses time. It increases the chance that many participants need to react at once. When too many actors try to exit through the same door, the door becomes very small. The silver market has seen this pattern before. Pressure builds quietly. Price begins to move faster than expected. Short sellers assume the move will fade. More paper supply is added to push price down. Sometimes it works. Sometimes it only delays the outcome. The danger is not manipulation. The danger is crowd behavior. Markets do not break because one group is wrong. They break when too many participants make the same assumption at the same time. In this case, the assumption is that silver remains a paper game, that delivery is optional, that inventory will appear when needed. But silver is not just a number on a screen. It is a metal that must be mined, refined, transported, and stored. Physical processes move slower than financial ones. When paper activity runs far ahead of physical reality, tension builds. Business leaders rarely watch silver closely. Many see it as a niche asset or a speculative trade. That is a mistake. Commodity markets often act as early warning systems. They reveal stress before it appears in credit markets, manufacturing costs, or supply chains. A large and rapid short buildup in silver is not about price alone. It reflects confidence in system stability. When that confidence is tested, the response can spill into other areas. Rising input costs, volatile hedging expenses, unreliable supply assumptions. The key point is this: the presence of a large short position does not guarantee failure. Markets can remain distorted longer than many expect, but it does change the balance of risk. It reduces margin for error. It makes outcomes more sensitive to small shocks. Silver does not need a dramatic event to move. It only needs a shift in behavior. A few participants choosing delivery instead of rollover. A few industrial buyers securing supply earlier than usual. A few investors deciding exposure is not enough. Pressure does not announce itself loudly. It accumulates. The appearance of a 25 million ounce short position is not proof that something will break tomorrow. It is proof that the system is being asked to carry more weight. And history shows that systems under increasing load do not fail on schedule. They fail when confidence changes faster than structure can adapt. This is why the signal matters. They often mistake activity for strength. From the outside, the silver market looks deep, liquid, and resilient. Prices move every second. Contracts trade in massive volume. Charts refresh smoothly. To many observers, this creates the illusion that silver is abundant and easily available. But that illusion exists because most of what trades is not silver at all. It is paper. Futures markets were designed to manage risk, not to move metal. A futures contract is a promise. It allows buyers and sellers to lock in prices without touching physical supply. This works well when most participants treat contracts as financial tools rather than delivery claims. The problem begins when people forget the difference. In the silver market, the same ounce can be referenced many times through paper contracts. It can be bought, sold, hedged, and re-hedged without ever leaving a vault. This creates leverage. Leverage increases efficiency, but it also concentrates risk. To understand where that risk hides, one must understand inventory. Silver stored in exchange-approved vaults is divided into categories. The most important distinction is between eligible and registered metal. Eligible silver meets exchange standards and sits in approved vaults, but it is not promised to anyone. It belongs to private owners. It may never be sold. Registered silver is different. Registered metal is tagged and made available for delivery against futures contracts. It is the pool that matters when someone stops rolling paper and asks for metal instead. This distinction is often ignored, but it is critical. When pressure rises, only registered silver can immediately satisfy delivery. Eligible silver can be converted to registered, but only if the owner chooses. There is no rule forcing them to do so. Eligible metal can also leave the system entirely. This means the market does not control supply. It only tracks willingness. As long as most participants roll contracts forward, this distinction does not matter. But when confidence weakens, behavior changes. Participants stop asking, "What is the price?" and start asking, "Will delivery be smooth?" This is where large, short positions become fragile. A short seller does not just bet on price falling, they bet on liquidity continuing. They assume contracts can be closed easily. They assume sellers will appear. They assume inventory will be available if needed. When price rises quickly, those assumptions are tested. As losses grow, margin requirements increase. This forces short sellers to post more capital or reduce exposure. At the same time, rising prices attract attention. New buyers enter. Sellers become hesitant. Liquidity thins. The system becomes reflexive. Price movement changes behavior, and behavior feeds back into price. Exchanges are not passive observers in this process. They manage risk through margin rules, volatility controls, and contract design. When markets become unstable, margins are raised. This reduces leverage and forces weaker positions out. Sometimes this cools the market. Sometimes it adds fuel by triggering forced exits. None of this requires manipulation. It is mechanical. The key vulnerability is that paper markets assume participation remains financial. They assume most players will not demand physical settlement. This assumption is usually correct, but it only takes a minority to change the equation. If even a small percentage of participants decide they want metal instead of exposure, pressure shifts instantly. Registered inventory becomes the bottleneck. Rolling becomes less attractive. Short positions face a new kind of risk. This is why paper systems rarely fail suddenly. They stretch. They absorb pressure by expanding contracts, raising margins, and encouraging cash settlement. Each step buys time. But each step also reveals stress to those watching closely. The silver market sits at a unique intersection. It is small enough that inventory matters, but large enough to attract global participation. It is financial enough to be traded heavily, but physical enough that shortages cannot be solved with accounting. This creates a quiet imbalance. Business leaders often miss this because they focus on price stability rather than structure. A stable price does not mean a stable system. It can mean pressure is being absorbed elsewhere. What matters is flow. When metal flows out of registered inventory faster than it flows in, tension builds. When paper volume grows faster than physical availability, optionality shrinks. When confidence becomes the primary stabilizer, the system becomes sensitive to narrative shifts. The mechanism that keeps the silver market functioning is not metal, it is belief. Belief that contracts will be honored smoothly. Belief that delivery will remain rare. Belief that volatility will stay manageable. The danger is not that this belief is false. The danger is that it is fragile. Markets rarely break because of one decision. They break because a structure built on rolling assumptions meets a moment when rolling no longer feels safe. That is the mechanism behind the warning. They could argue about charts. They could debate positioning. They could even question whether shortages were exaggerated. But the factory did not care. Silver is not consumed by opinion. It is consumed by process. Once it is built into a product, it does not return to the market easily. This is what separates silver from many assets that trade alongside it. Unlike purely financial instruments, silver disappears, and industrial demand does not wait for better pricing narratives. It does not pause because volatility rises. It responds to orders, contracts, and production schedules. When a manufacturer needs silver, they secure it. Delay is not a strategy when output depends on it. This is where paper logic begins to lose authority. The modern economy runs on conductivity. Electronics, energy systems, medical devices, and industrial equipment all rely on silver's physical properties. There is no substitute that matches its performance at scale. Engineers can reduce usage per unit over time, but they cannot eliminate it. Efficiency gains exist, but efficiency has limits. For years, manufacturers reduced the amount of silver used in products. This process, often called thrifting, slowed demand growth. But as technology matured, the easy reductions were exhausted. Further cuts became costly or impractical. At the same time, demand expanded. Energy transition policies increased solar installations. Electrification increased component complexity. Medical applications expanded quietly. Each individual use seemed manageable. Together, they formed a persistent draw on supply. This matters because industrial demand behaves differently from investment demand. Investors can sell. Factories cannot unwind production easily. Once demand is locked in through contracts, it becomes inflexible. Silver supply, however, is slow. Mining output does not respond quickly to price. New projects take years. Recycling helps, but recycling flows depend on price, logistics, and time. Inventory becomes the buffer between supply and demand. Buffers are meant to absorb shocks, but buffers shrink when deficits persist. When consumption exceeds new supply, above-ground inventory fills the gap. This works until inventory holders decide to protect themselves. When that happens, metal stops circulating and starts hiding. Paper markets cannot solve this. They can create more contracts. They can widen participation. They can increase liquidity on screens. But none of these actions create atoms. They only redistribute claims. This is why industrial demand is so dangerous to paper structures. It is not negotiable. It does not care about positioning. It does not respond to margin changes. Factories do not roll contracts. They take delivery. As long as industrial demand remains stable, paper markets can manage stress. But when industrial demand grows while inventories tighten, the system loses flexibility. Optionality disappears. This creates a subtle but powerful shift. At first, nothing looks broken. Prices rise, but markets function. Then delivery interest increases slightly. Then inventory withdrawals accelerate. Then lead times stretch. Each step alone looks manageable. Together they signal pressure. The important point is timing. Industrial demand does not spike overnight. It accumulates. It compounds. And it often becomes visible only after it has already altered supply behavior. This is why silver behaves differently from gold. Gold can sit idle. Silver must work. And working metals do not return easily once deployed. For business decision makers, this distinction matters. Input volatility does not need panic to cause damage. It only needs uncertainty. When supply reliability becomes questionable, planning costs rise. Hedging becomes expensive. Margins compress. Silver's industrial role means its market sends signals before broader economic stress becomes obvious. When industrial buyers begin securing supply earlier than usual, it is not speculation. It is risk management. When they hold inventory longer, it is not hoarding. It is insurance. Paper markets often misread this behavior. They interpret rising prices as speculative excess rather than structural tightening. This leads to incorrect assumptions about reversals. The real pressure does not come from investors chasing returns. It comes from users protecting operations. This is the quiet force reshaping the market. As industrial demand continues, the paper system is forced to adapt. It can stretch by encouraging financial participation. It can delay by reshuffling contracts, but it cannot reverse consumption. Every ounce used in production is one less ounce available to stabilize the system. Pressure builds not because of headlines, but because of flow. And flows do not announce themselves until options are already limited. They might believe this is only a metal story. They would be wrong. What is unfolding in silver is not unique. It is a case study. A visible example of how modern markets behave when financial structures stretch far ahead of physical reality. For business leaders, entrepreneurs, and decision makers, the lesson is not about silver prices. It is about risk recognition. Commodity markets are early messengers. They react before balance sheets adjust. They respond before earnings calls change tone. They reveal stress before it appears in employment data or credit spreads. When a commodity that sits at the intersection of finance and industry begins to show strain, it is rarely isolated. Silver's warning is structural. The presence of large paper positions, tightening physical buffers, and growing industrial pull exposes a broader truth about modern systems. Efficiency has replaced redundancy. Leverage has replaced margin for error. Stability increasingly depends on confidence rather than capacity. This matters because confidence is fragile. When systems rely on rolling behavior, smooth logistics, and uninterrupted liquidity, small disruptions can have outsized effects. A delay here, a margin change there, a supply reassessment somewhere else. Each action is rational on its own. Together, they can reshape outcomes. For businesses, this creates hidden exposure. Manufacturers depend on predictable input costs. Entrepreneurs depend on reliable supply chains. Financial planners depend on orderly markets. When commodities become unstable, volatility does not stay contained. It migrates. First, it appears in hedging costs, then in procurement timing, then in pricing assumptions. Eventually, it reaches consumers. The mistake many decision makers make is assuming that paper markets guarantee availability. They see liquid prices and assume supply is secure, but liquidity on a screen does not equal flexibility in the real world. Silver demonstrates this clearly. Paper markets can expand endlessly. Contracts can multiply. But physical systems cannot. Mining, refining, and fabrication move at human speed, not algorithmic speed. When demand accelerates faster than supply can respond, buffers shrink. When buffers shrink, optionality disappears. This is where strategy matters. The businesses that suffer most during commodity stress are not the ones with exposure. They are the ones without preparation. Those who assumed stability would persist. Those who optimized for cost rather than resilience. Entrepreneurs often underestimate this risk because it feels abstract. Silver does not sit in most boardroom conversations, but its behavior reflects a deeper pattern. The growing gap between financial promises and physical limits. This gap exists everywhere. Energy, semiconductors, logistics, labor. Each sector has built systems that work beautifully under normal conditions and struggle under stress. Silver is simply flashing earlier. The lesson is not to panic. Panic is never strategic. The lesson is to observe. Markets do not fail because people lack information. They fail because people ignore signals that do not fit comfortable narratives. Silver's signal is uncomfortable because it challenges the belief that paper systems can always adapt. They can adapt, but not infinitely. Decision makers should not ask whether silver will collapse the system. That question misses the point. The better question is what silver is revealing about how systems behave under pressure. It shows that leverage magnifies confidence. It shows that efficiency removes slack. It shows that optionality is lost quietly, not dramatically. For entrepreneurs, the takeaway is simple but difficult. Resilience is not free. It costs capital. It costs patience. It costs the willingness to look inefficient in good times. For business leaders, it reinforces the importance of stress testing assumptions. Not just financial assumptions, but operational ones. Where are dependencies hidden? Where does supply rely on trust rather than inventory? Where does pricing rely on calm behavior? Silver does not answer these questions. It asks them. This is why the warning matters even to those who never touch the metal. It highlights a pattern that repeats across cycles. Systems stretch, signals appear. Those paying attention adjust early. Those who don't are forced to react later. The final implication is psychological. Markets reward preparation, not certainty. Those waiting for a clear break often act too late. Those who treat warnings as noise miss the chance to reposition calmly. Silver's story is not about inevitability. It is about probability, about recognizing when risk shifts from unlikely to asymmetric. The warning is not that something must break. The warning is that the cost of being wrong is rising. And when that happens, the smartest move is not prediction, it is preparation.